a singular secret sauce that OpenAI has, but all of those together just really make it an interesting company.
Yeah, I mean, I guess the secret sauce isn't so secret, right? Because we all see it in terms of the adoption of ChatGPT. What I find interesting, Kyle, is that, certainly when we talk to people, even people who are AI bulls who invest in it, they do share some of these concerns about the so-called circular economy, right? And the NVIDIA investing in OpenAI, which is using some of that money to buy NVIDIA chips, et cetera. Has that had any kind of effect on its fundraising ability?
You wouldn't be able to tell it if it has, right? If it's jumping from 100 to 300 to 500 in consecutive years and raising $40 billion from investors and secondaries going up at, $6.5 billion, every 6 months or so, like if there is any hesitation because of the circular economy, you're not seeing it in the fundraising.
The other issue that has been sort of dogging OpenAI for a while now is this separation that it has been attempting to do or is going to attempt to do between its nonprofit and for-profit arms. That has faced some legal challenges. Is there any chatter on that in the fundraising world and what that's going to mean for the company going forward?
I mean, I think it's really tough to have too much chatter on that until you kind of, get the full run out of what's going to happen, right? Obviously, if it has to stay a nonprofit, that's going to be very difficult. But the way it's moving and the way it's partnering with all these big tech companies, it's tough to think that there's any more hesitation because of that either, right? Obviously, that got a lot of talk when Elon Musk was diving into and setting up challenges for Sam Altman and OpenAI. But there hasn't been too much talk about that specifically over the past few months.
Kyle, you've been covering this world for a while. How anxious do investors get to exit, right? And what would an exit look like for OpenAI? And at some point, what does that cycle tend to look like?
I think OpenAI is going to be very different than every other company we've seen go through the kind of venture life cycle, right? You're at $500 billion. You have ample amount of private capital waiting to take secondary shares, so you can get employees, early investors, the liquidity they're looking for. You have, no real reason to go public now with the growth that they're seeing in the private markets. That going public is going to add a little more cost and a little more hurdles to get through when they're just trying to operate and kind of really charge forward with their revenue growth. So I don't see an exit necessarily like a traditional exit from an IPO, or obviously not an M&A is going to happen. But an IPO is not going to happen in the next year or two for OpenAI, right? Until you start to see that private market capital dry up for this company specifically, there's no reason for them to go into the public markets.
Are they going to be under any pressure to go profitable anytime soon, Kyle?
I don't actually know that they would be able to go profitable in the near term, right? When you look at the cost and the way that that's grown too, they blew their cash burn rate was about $2 billion through the first 6 months of the year. They're looking for $6 billion in total burn in 2025. That's not something that they would be looking to just cut and completely change their business model, right? They need that money to be put to work. They need it to continue growing, to be bringing out new models, to reaching new customers, to creating new inroads for enterprises into their business. So they're not going to be cutting that burn anytime soon. So I don't see this becoming a profitable company.
Go ahead, Kyle. What were you going to say?
Oh, I was just going to say, obviously, the energy costs are another thing, right? If you're spending a lot of money to run all of these chips and all the energy that's taking, without energy prices coming down, they're going to have a huge cost in that category, too.
And the final thing I wanted to ask you, Kyle, is with so much capital going to OpenAI, are we seeing other companies kind of be starved of capital and having trouble fundraising because so much is going in this one direction?
I don't think it's because of OpenAI, right? And when we look at the startup market, it's really kind of two different markets, all of AI and the rest, right? When you look at who's investing in OpenAI, it's Dragoneer, it's Thrive, it's SoftBank. Like those are firms that are not short on capital and are able to get capital in different areas than just the dry powder in their VC funds, right? So I think when you look at the rest of the market, though, if you are not an AI native company or haven't integrated AI into your business model, it's a really challenging environment to raise. So it's not going to be one single company that is taking a lot of the money from startups right now, but AI in general is having kind of like a 2021 looking chart up into the right every year, new deal count or new record deal count, new record deal value. That is taking money away from the non-AI companies who are unable to kind of create that revenue growth that they might have seen up through 2021.
Thanks, Kyle. Appreciate it.
Of course. Thank you.
Well, despite recent strength in the IPO market, more and more companies are choosing to stay private for longer, including OpenAI. We spoke with OpenAI CFO Sarah Fryer to ask about the company's plans for a public offering.
To me, an IPO is just another form of a fundraise. So will we still be fundraising to keep funding compute? I suspect the answer to that is yes. And so right now we need money to invest in compute, money to invest in great researchers, and we need to keep bringing customers along by showing them value, whether it's enterprise customers all the way through to small businesses, to consumers.
And as we just heard from Kyle Stanford, he doesn't think it's going to happen anytime soon. Let's talk more about the state of private markets. We're joined by Eric Hirsch, co-CEO of Hamilton Lane, which is a global investment firm focused on private markets, including private equity, credit, real estate, and infrastructure, with $986 billion in assets under management and supervision. Eric, it's good to see you. It's an interesting moment, isn't it, as we have been talking about this private fundraising that has happened for the likes of OpenAI, but of course not just OpenAI. What do you make of it? And through your career, how has this kind of changed? What has been the real reason that so many companies are getting so large on the private side?
Julie, always good to be with you.
You too.
I think what you're seeing is this is a sort of typical maturation and an evolution, which is if we go back a couple of decades, people wanted to be public. That was the hallmark. That was the stamp of success. That told your customers and your competitors that you had made it. That's no longer true today. So today, the number of public companies has generally been trending down and to the right for the last several decades. And there's a few reasons for that. It's expensive, time-consuming, and all of that to be a public company. I know, we are one. But it's also the fact that the private markets have continued to develop, mature, and grow to a point where there's adequate capital to allow you to stay private for as long as you want to.
And do you see any kind of change to that equation?
I don't. I think, frankly, this is just giving choice to the market. If you want to be public, and by the way, again, we made that strategic decision several years ago because we saw some real strategic advantages for Hamilton Lane to be public. But if you don't see those advantages, or you frankly see more advantage in being private and having private capital, private partners helping you grow, then you've got the optionality to do that. I think this is a good thing. It's not a great thing for the public markets because, again, there's just less choice going over there. But I think it's a good thing for companies to be able to chart their own path depending on which one makes the most sense for them.
Well, and it's also maybe one of the things that is less good is that, you know, most investors, the vast majority of investors, don't have access to the private markets, right? They can't invest in OpenAI. That maybe seems to be changing a little bit. Do you think it is going to change, and how quickly is that going to happen?
So I agree with you that that has been a real downside for individual investors. If you're not part of a pension plan, where those, frankly, a lot of those returns are coming from the private markets, you've basically been left out and left behind. That is changing. So with the advent of a series of products referred to commonly as evergreen funds, private markets are now being much more accessible to the mass affluent. That's still not everybody, but it's a big step forward for people with a couple $1 million net worth, and there's a lot of those people, as we know, in the United States, but that is happening now. And if you look at the exposure for that customer base, it's basically 0%. But the change is here, the change is coming, and I think it's going to occur very rapidly. The next question then tends to be, do you think we're going to get that private market access moved into the 401k market? And I think that's a different question.
What's your answer to that question, Eric?
I think we will eventually, but I think we're going to see more. We need more than simply an executive order or the administration saying, hey, let's make this happen. I think you're going to see real regulatory reform required in order for that to happen in a way that makes sense for the consumer of that product and the provider of that product.
I want to switch gears and just ask you as well about something that's been going on in the news, and that's the government shutdown. Because I know it's something you're watching, but I'm curious specifically. We've had the IPO window finally open back up. The number of IPOs, that allows exits for firms like yours and stuff you've invested in. With the SEC, you know, presumably on furlough like everybody else, does that run the risk of sort of slowing down that momentum?
I think this is a question of duration. My own view is that we're going to see this likely get resolved this week. But if I'm wrong and this stretches for weeks or longer, then I think you're going to see ripple effect. I think right now the market is telling you that they also believe this is going to get wrapped up and resolved in relatively near term. But again, if that proves to be incorrect as we sort of see what happens or doesn't happen this week, then I think you are going to see ripple effects, not just simply from the SEC, but we're going to start to see some ripple effects across other broader parts of the economy.
So I guess then, all things being equal, let's say the shutdown is short. Do you think that the IPO window is, that things are now sort of open for business again? And what does that mean for exits in your business?
Well, I think it does mean that you're open for business. If you look at how recent IPOs have traded, generally have been trading very strong. I think part of that is this sort of pent-up demand of the market is looking for more diversity and more product. If you're a primary public market investor, you are dealing with an equity concentration, market cap concentration, the likes of which we haven't seen in recent history. And so you've got a small number of stocks driving the performance of the indices. And I think investors are smartly looking to try to get more diversity in their portfolios. And I think that's been a big reason why you've seen strong performance. And once you see strong performance of recent IPOs, what does that result in? It tends to result in more IPOs.
Right.
That's a good thing for the markets. It's a good thing for the private markets who are using that as an exit environment. So I think all of that is a positive trend.
Eric, great stuff. Thank you so much for your perspective. Appreciate it.
Great to see you, Julie.
And for more private market data, you can head to Yahoo Finance or scan the QR code below to track private markets, including valuations, fundraising, and more. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
If you've ever tried to clean a garlic press, you are going to love this. Introducing the Great Garlic. No chunks, no squeeze, no stuck pieces. It's faster, cleaner. If you cook even a little bit, you're going to need one of these. Scan the code on your screen now.
Introducing the Great Garlic, your ultimate kitchen companion. Just place a peeled clove of garlic under the grate, rock it back and forth, and say goodbye to tedious chopping and messy mincing. Scan now and find out for yourself. Great Garlic is
titanium, stronger than steel, lighter than aluminum, trusted in aerospace, and now redefining the way we prepare food at home. Resists corrosion, never absorbs odors, and remains flawlessly food safe without ever breaking down into harmful microplastics. Titanium Edge, now available. Exclusive television offer.
Out on the range, freshness is hard to come by. Whether you're riding, wrangling, or just chilling by the fire. Keep your liquids lassoed with the Liquid Lasso. Airtight and leak-proof performance that keeps bottles sealed, safe, and ready when you return to camp. And don't forget about Liquid Lasso's trusty partner, El Corco. It's bueno. Scan the code and tip your hat to the finest bottle wranglers in the West. Don't don't squat with your spurs on.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. First up, Micron, the chipmaker getting a boost after Morgan Stanley upgraded the stock to overweight from equal weight, citing a multi-quarter stretch of double-digit price increases. Analyst Joseph Moore is saying Micron is, quote, pushing the envelope on valuation, but does see price gains translating to substantially higher earnings power. He adds this pricing upturn should resolve any lingering questions around Micron's high bandwidth memory chips and set a $220 price target, signaling about 12% upside from current trading levels. Next up, Klarna. Wedbush initiating coverage of the buy now, pay later giant with an outperform rating and $50 price target. Analyst Scott Devitt calls Klarna a tech-enabled bank at the center of the commerce ecosystem with strong exposure to alternative payments, AI-driven underwriting, and digital wallet growth. Wedbush expects sales to climb about 20% a year through 2028, with profits growing even faster as new markets mature. The firm also highlighted Klarna's AI partnership with OpenAI, which now handles nearly 70% of customer service chats, one of the reasons they view the company as leveraging AI for both efficiency and scale. And finally, Shake Shack under pressure after Bank of America cut the stock to underperform, warning that margin pressures from rising beef costs and elevated competition could weigh on results. The downgrade also flagged that Shake Shack's plan to grow to 1,500 domestic store locations could be too ambitious, calling out saturation risks outside high-income markets like New York. BofA also lowered its price target on shares to 86 from the prior 148, citing a tough consumer backdrop and price-sensitive diners. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
It's a big M&A Monday with the largest bank deal since 2023. Cincinnati-based Fifth Third will buy Dallas-based Comerica for $10.9 billion. It creates a bank with about $288 billion in assets. Joining us for more, our banking reporter, David Hollerith. Good to see you, David.
Hey.
So what do each of the banks get out of this deal?
Yeah, for Fifth Third, it means that their expansion efforts in the Southeast and Southwest is going to be turbocharged essentially by Comerica, which is a Texas-based bank's commercial division. They have like a very large traditional banking commercial business, which is heavily sought after, even by the country's largest banks. And so really for both banks, it's a big question around scale. Ever since the 2023, we call it the mini regional banking crisis, regional banks have been they've seen sort of the disadvantages to their size, being bigger than community banks in a certain way, and then also being much smaller than the mega banks. So they both have a need to grow. Comerica in particular, their stock and performance, their earnings performance has lagged peers for over a decade. And more recently, there's actually been activist attention on the bank. Holdco Asset Management published this 52-page, pretty critical report back in July. and their consensus was they'd taken a 1.8% ownership of common shares of Comerica, and they were urging Comerica to sell itself. They were even taking steps to do a proxy battle early next year, or I guess that would kick off in December. But so there's plenty of pressure on Comerica. In general, there was some pressure on regional banks in terms of their stock performance relative to the bigger peers.
Right.
And Fifth Third is an acquirer bank. They're pretty strong. They have a very strong Midwest presence, and they're trying to grow in the hot markets, which have been the southeast and southwest for a while.
And so when you talk about this sort of in-between place that the regionals are in, bigger than the community banks, smaller than the mega banks like the Cities and Bank of Americas and JP Morgan, what does this increased scale, sort of do for them? How does it help them to better compete?
Yeah, well, for Comerica, it's a big deal because they didn't really have a retail franchise. And retail deposits are known as being some of the stickiest in banking. And so it's a lot more stability for them. For Fifth Third, it means that they have more scale, more ability to make loans using their deposit base and to expand into commercial banking, which is, they call it like C&I lending. That's kind of the hottest.
Commercial and industrial, right?
Yes,
Yeah.
yes. It's one of the hottest places for traditional banking in the U.S. So.
And we also are at a moment where rates are coming down, right? So does that, I guess for banks, it creates both vulnerabilities and opportunities, particularly at that level where they don't have, for example, a big trading operation to offset some of that.
Sure, yeah. Interest rates coming down are generally seen to be good for regional banks that have, these bigger mortgage operations and the commercial real estate and also C&I lending.
So they could see more demand as rates come down.
Exactly. Whereas bigger banks are typically seen to be more asset sensitive, meaning that they benefit from higher interest rates because they get thicker margins. Really, to cut it, it's hard to know between any one bank how interest rates are going to affect them, and it all kind of depends on, how things fare as interest rates begin to cut. So.
Yeah, and then finally, I'm also curious about the regulatory environment that allows a deal like this to happen, right? Because we don't see big banking deals that often. Is the regulatory environment more friendly to this kind of stuff right now?
Absolutely. I was speaking to this guy who's known as basically the Wall Street banking surgeon. He's done a lot of distressed deals in the past. And he had said to me last week that effectively this is the most favorable environment he's seen in a very long time, especially compared to the Biden administration in terms of their bank merger policy. And, you can't help but read through the fact that since 2023, there's some need for that, even no matter what side of the political aisle you sit on, that banks for a while have needed to merge to compete with the mega lenders.
Dave, thanks so much. Really appreciate your reporting on this, and fun to talk about a deal this morning.
Absolutely.
Thanks. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
your phone, wallet, keys, loose change, and more fall between the seat and center console of your vehicle, it's impossible to retrieve. Oh no, not again. Introducing the Console Catcher, the perfect addition to any vehicle. It's flexible, easy to clean, and even easier to install. Simply place the console catcher around the base of the seatbelt buckle, and that's it. The console catcher keeps anything from falling between the cracks, and it even doubles as a handy organizer. Scan the code on your screen right now to get a complete set of console catchers for both front seats. And if you scan the code on your screen and order right now with this special TV offer, you can take 20% off. If you have a car, truck, minivan, or SUV with that frustrating gap between the seat and console, you need the console catcher. Simply push it into place and the console catcher moves with you. Scan the code on your screen now and get your car today.
When it comes to bath time, our dogs deserve better. During their most personal moment, show your love with the Bubble Brush. With its built-in shampoo dispenser, the Bubble Brush cleans and soothes your pet's skin while removing dirt and loose fur. Your dog will love it. Chappie gave it a 5 poop rating, our highest honor. Make bath time their most cherished experience with the Bubble Brush.
Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here today with Ben Connard, Carnegie Investment Counsel Portfolio Manager. Ben, it is great to see you. So we're going to start on a name you like, Ben, and that would be Microsoft, which has had a good run already, Ben. It's up about 25% year to date. Most analysts on the street, they still like this one. You do too. So let's walk through some of the reasons why. The first reason, Microsoft 365 commercial revenue.
Sure. Microsoft has a huge base. They've got about 400 million commercial users. That provides a steady source of revenue for the company. It's pretty